All right. And so I was told to speak a little bit about positioning and pricing, and I'm going to stress this. It's positioning and pricing because they're very, very closely aligned. And so the presentation is best practices and learnings from 500 startups, literally 500 startups that we've seen a lot. All right. And so, who I am, quick introduction. I've actually been in Silicon Valley now almost 20 years. So I actually originally from Vancouver, otherwise known as Vancouver. So I'm actually Canadian. And so I moved to Silicon Valley back in '99 for the gold rush to get rich, and it didn't really quite work out. But due to that, I learned a lot of stuff along the way. So I have been in startups, as mentioned. I was at Yahoo for about 10.5 years, so I was very fortunate to catch the second bump up. And of course, it's the second decline, which ended up where they ended up right now. But you learn a lot on the way down. And I also mentored a lot of startup accelerators. I think 23 or 24 now as of last count. And so my sample set is very, very, very large. And tell you a little about 500 startups. So 500 startups started off about 8 years ago as a seed venture capital fund. So we invest in the very, very early stages. And because we didn't think that was enough work to do, we started an accelerator program about 7 years ago. And now if you look at sort of the rankings, we're probably in the top 2 or 3, depending on who you ask. And we invest in a lot of companies. So 500 startups overall between our seed fund as well as our accelerator program has actually invested in close to 2,000 companies worldwide. And we are very, very unique in the sense that we are one of the very few Silicon Valley VC funds and accelerator programs that invests outside of the US. So probably about 35 to 40% of our portfolio is actually outside of the US. And if you also ask, like, why am I qualified to speak about sort of SaaS overall, a lot of it's due to the deal flow that we get. So I have now run 10 programs at 500. And I'd say over the last 2 to 3 years, we've seen a big, big shift from a lot of consumer companies toward more B2B startups, just from a pure deal flow perspective. And because of this large sample set of SaaS companies we invested in, we've learned a lot of things along the way, from good and bad. All right, let's jump into this. Great quote to kick this off, right? The moment you make a mistake in pricing, you are eating into your reputation or profits. So think about that, right? Like, think about that. And yet, at the same time, how much time do companies actually put into their pricing strategies? Whether you're a big company or a startup, you probably, I'd say a lot of companies spend more time figuring out their interior design of their office than they actually do into pricing, all right? That's a fact. And why is this important? It matters because 1% of improvement in pricing leads to about 11% of profits, increase in profits. And this must be a real number because this came from those arrogant, elitist folks from Harvard Business School, right? So it must be real. But you get a general idea, right? Pricing is actually very, very important. But before you do this, and I think this is sort of hammered on, will be hammered on by many, many of the speakers actually for this, for the next couple hours, is you need to understand the customer segment that you're going after, right? For me, when I meet a founder and I go, who's your customer? Who are you targeting? You better have a very, very clear view, whether you're a big company or small company, on focusing on a very, very tight band of customers. So anyone who says, I target everybody, you're an idiot, and your company is going to die a painful, painful death. Right? So having said that, so to begin with, before you go into any of the pricing, go figure out what your ideal customer profile is, and if you're early stage, as narrow as you possibly can, right? So whether it's a consumer side or B2B side, I don't care, but just super, super focused in whether it's vertical industry, some subset of the vertical industry, could be SMB, maybe it's on the M side, maybe it's enterprise, I don't care, but you better have a clear view. All right. The other thing, has anyone read this book, Positioning? This is an old book, came out during the 80s by Al Ries and Jack Trout. So positioning, right? Positioning is actually really important. Remember the previous quote about the fact that once you screw up pricing, you screw up your reputation? It's actually true, right? So if you're going after enterprise in general, you probably want to price a little bit higher, right? And especially understanding who your ICP, the ideal customer profile is actually important because it actually helps you define the categories, right? And categories are important because if you are a startup, whether you're going after sort of a predominant category that everybody knows already, or you're setting up a category yourself, it's actually critical. And so Pricing, and this also helps you determine whether you should be focusing on premium pricing or sort of more lower end pricing, doesn't really matter, but it's actually important. And I recommend this book to anybody. Before you even start the exercise of figuring out what pricing is, start with positioning. How are you positioned in the market? Are you a premium player? Are you a low cost player? And I think a lot of people get this mixed up. Okay, I'll let that sink in. So get this book, read this book, it's great. So principle number 1, I'm going to go through about 18 principles, right? The truth is, everybody screws this up. Everybody gets it wrong, right? And I think I've been very, very fortunate where a lot of times, and this is where I think the media does a very, very bad job, right? A little bit too much hero worshiping. They spread all these like myths. That's why I love TechCrunch, but I hate TechCrunch at the same time. And so a lot of times you hear these like hearsay stories of like, well, like they did this and all of a sudden this thing happened, right? And I think the reality is that if having been in the Valley and having friends that work at all these like really amazing companies, like they all screw this up. Salesforce screwed this up like for many, many, many years. HubSpot, like any of the big giants that you hear about, they have all screwed this up. So understand that, right? Don't be so hard on yourself. You will screw this up too, right? This is a rule in the law. So just don't worry about it. And this is what we're going through, right? I'm going to provide you a bunch of principles so you understand how to do pricing better. All right. The other thing, and this was, I think Rich covered this, don't ask people what they will pay for your product because they have no clue. All right? And this is actually goes back to a lot of behavioral sort of psychology, pricing, like they just don't know. And a lot of times they either undercut, and just from an alignment perspective, it makes zero sense. Most of the time they will not know. So asking people what they will pay for your product is, I think as a newbie, you do this because you're like, well, I want to get a good guidance. It's actually the wrong way of actually starting off. Principle number 3, which we'll spend a little bit more time talking about, I think, in our workshop tomorrow, is just you literally have to test everything all the time. And there are a lot of methodologies for it. I am a very, very big fan. There's a lot of methodologies and a lot of tools for this. And so I'm actually a very, very big fan of like A/B testing and use things like Unbounce and lead page. There's tons of these things that you can actually test these things out, right? Test it on different sort of demographics and audiences. Because the reality is that you don't know until you actually launch something, or at least you sort of see sort of what the feedback is. The other thing, you have to be very, very systematic. And I actually think in this day and age where there's so many analytical tools available and you're not using them, things like that are free, like Google Analytics, right? Like, I'm not sure they're the best tool, but tools like that, there are tons of analytical tools you can actually implement in your product to track what's going on. And the way I think about this is that you want to be thinking about having like regular experiments on a regular basis and tracking them. And if you look at all the best companies in Silicon Valley, whether it's consumer-based or enterprise-based, they literally test everything. And they have these like boards of like, these are all the experiments we're going to run like this week, or the 4 or 5 experiments we're going to run this week. My best companies do this on a regular basis. Because the reality is that you don't know until you actually launch this stuff and send it out in the marketplace and see what the feedback actually comes back, and do this on a regular basis. What's this? Principle number 5, especially for the early stage companies, I think you get this feedback and advice a lot of time from VCs, who most of them suck, by the way, right? But that's another story. You get this advice like, oh, services are terrible, like services are really bad. I'm like, yes, like if you are like a company that's been for 10 years, like maybe, and your big part of your business is like service oriented. But I actually think in the beginning, especially as an early stage company, services are actually a great way to do paid customer development. And I also think there's a lot of benefits in this because especially if you're selling to large enterprise companies, dirty secret of large enterprise companies, if you actually get through their procurement process, a lot of times they, because they're used to working with those like horrible companies like Oracle and SAP, there's usually a component actually attached of services to that automatically, because they just assume with any software implementation, there is a service, a component to it. And so what I would say is this is why services are very good. Number 1, you get to do customer development and they're paying you for it. You actually allow yourself to build a lot more relationships within the organizations. So from a sales perspective, that's actually a really, really good thing because people change all the time. So you want a lot of champions in the organization. And then the other thing too, is just like the feedback that you actually get from the customers, from multiple parts of the customers, is actually very, very valuable. And you make money off this. So it allows you time to actually pump this money into engineering, into building the product. And so in early days, I think services are a critical piece of actually development. One thing the one thing we'll say though, you have to be very careful around this is services can be risky because sometimes it's like a drug, right? You kind of get used to the revenue and then you stop paying attention to actually developing the product. So this is something you have to watch very, very closely. But as an early stage company, it is a very viable strategy to get started and to get your company up and running, right? And to get really valuable feedback for your product and service. Does it make sense so far? I see a lot of like blank looks here, or maybe it's the light. Okay. Okay, and just to mention, right, like I have really, really strong and usually uninformed opinions, but my view is just like, I think freemium, especially if you're doing like B2B, if you're doing consumer product, that's a completely different beast because there's a lot of business models you can build on top of usage. But I think for B2B, I think freemium is really, 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 really stupid because of the fact that you're giving away your product for free in general, and you should be charging for it. Just my view, and I can talk to you more about that later on. But I'm actually a big fan of actually free trials. And if you looked at it, and based on our experience of working with a lot of SaaS companies and many of my companies, what I see when they do a lot of free trials, general guidance overall is that the shorter time that you give for a free trial is actually better. There's been a lot of literature on this. And what I find with at least the experience of my companies and in my experience is that the shorter time frame that you give for a free trial could be 1 week, 2 weeks, but usually not more than a month because there's definitely benefits. You give them more time. The good thing about it is that, hey, I have a complex product, so they have more time to explore the product and use the product. But what ends up happening is the more time you give them, people are lazy. So they go, you know what, I'll just go and check this thing out like in a couple weeks from now. Or most of the time, they just forget about it. And so having a shorter trial period time puts a little bit more urgency in allowing them to sort of test and use your product. All right. I think this thing went out, but that's okay. The other thing too is, and you would think that should be a basic thing, but sometimes people don't do the basic things, are really understand the value that you are giving your customer, right? Like what does the customer actually get from using your product? Do they make more money by using your product? Do they save more money from using the product? Do they save time? Whatever it is, and this is in line with what Rich mentioned earlier, but this is actually critical because if you do not have this information, it makes it very, very hard to figure out your value proposition, figure out your positioning, and because of that, figure out your pricing. The other thing that's actually important, also very closely aligned with sort of like the sort of sales as well too, you should probably have a good understanding of what their buying process is. And this seems very, very basic, but it's also very shocking to me when, for example, I'm meeting startups and then they're going, well, we're targeting these Fortune 100 companies. And I'm like, well, okay, if you're targeting these Fortune 100 companies, like, have you thought through like how they're buying, who you need to talk with? Like, does it need to go through procurement, right? Like, if you go through procurement, that's a completely different process. How you price and think about that will be different. Right. Thank you very much. The other thing you should know, at least have a general idea of what your customer sort of like lifetime value is. And this is going to vary because a lot of it depends on who you're targeting. A lot of it depends on what your product actually does, right? Because in some products, for example, in like HR tech or whatever, like there's a lot of, it's very seasonal, right? And so they use it for a period of time, then they'll jump off. And versus say other sort of like must-use products on a regular basis, like CRM systems, the customer lifetime value is actually really, really long, right? Because you think about that, whether things like SAP or things like CRM systems, the lifetime value is quite long because once you've kind of gone and taken the trouble, or Xero is another great company, right? Once you've kind of inputted all your data into the system, like the likelihood that you're going to change over and actually switch to somebody else is actually pretty low. And so understand the type of product that you're actually building and the use case you're actually serving will actually help you understand sort of what your customer lifetime value is. Okay. The other thing I'd say, anchor high, right? Very, very important of just like, and this is something that I work with a lot of our companies, is most of you are probably undercharging your customers. You know what, I'm gonna say all of you are probably undercharging your customer. Pretty much. And so the guidance I give is that, you know what, if you have a number like that you have in your head that you're thinking about charging, like charge a price, like double it or maybe even triple it to the point that you're so uncomfortable and embarrassed to go and like talk to them. Like that's probably the right price, especially if you're a startup, especially a startup founder. right? And there's no science to this. It's just like a lot of times, and I'll tell you why this thinking actually happens among startup founders, because you go, well, I have all these grand plans, and we should be able to do this, and you're perfectionist in some ways, right? Where it's like, the product I have right now is kind of crappy. It's like, it doesn't really fix that, so like, I want to kind of there's two reasons to do that, right? It's like, I want to kind of undercut everybody, because like, this is sort of the way you're supposed to do it because of these so-called Silicon Valley myths that are all untrue. And so that's one part. And the other part is just like, I just have this grand vision of what my product could be, and I'm nowhere close to that, so I don't feel comfortable charging for that. And I'm just like, well, then I just think it's you have to get out of that mindset, and I think it tends to be more of an issue for startup founders and it's something you just have to get over, right, just in general. The other thing I'm going to say, like strong views on this, I think discounting is really, really stupid, and I'd say in most cases, like you're a gutless coward if you are discounting your product in general, all right? You're a gutless coward. Anybody can discount your product, and this is what it tells you, right? Like when you're pitching your product, you're like, my price is this, and they're like, oh, I don't want to do this, and then you're like, okay, I'll just like, how about this, at 20, 30%? It makes sense in some cases when you're getting like big volume deals, or if your product is actually going to lock them in for a long time, like if it's a CRM project or whatever, because that's actually the secret of like a lot of these like ERP systems and CRM systems, is you lock them in, and then you get them forever, and then what you do is you jack them later on and just like raise the prices on a regular basis, right? That's what SAP does, right? That's what they do. They don't like it, but that's what they do. That's what Oracle does, right? And so it depends on your product in general. Like it might make sense for some products. I would argue in most cases, discounting does not make sense. And so it's something you want to control very, very, very carefully. Having said that, if you put this one together, do like the Chinese sort of grocery store thing, raise the price, double your prices, and discount 50%, do that. That's probably better, okay? All right. The other thing you have to say is, as a startup, you have to evolve over time. And so this is a great example. Like we have one of our portfolio companies, a company called TalkDesk, a very, very well-known company, at least if you have doing like call center in the cloud. They're probably worth like $500 million now. But how they started off actually in the SMB, targeting a lot of SMBs and targeting startups for their services. And over time, they've actually evolved. And actually now, if you actually see their customer base, majority of their customer base is actually enterprise. And so over time, especially for SaaS, and especially as you build more and more robust features and things into your product, you will probably have to evolve, and you want to evaluate. This is something you want to evaluate on a regular basis to see, like, are there any other customer segments you actually want to be going after? And a typical Silicon Valley startup in general usually starts with like sort of SMB sort of like segment, and over time, and in my opinion, I also think because the SMB segment kind of sucks, over time they're forced to actually move up to sort of the enterprise space. And there are reasons like I go, why does Marvin think the SMB market sucks? The challenge with the SMB market is just that a lot of the SMBs die, right, very quickly because they're just early and young. And the other issue too is customer acquisition. There are very, very few channels and very, very few companies that have been able to grow SMB-focused SaaS businesses. Somebody will do it, but right now, the jury is still out on that. And from customer acquisition, why I'm just very, very skeptical, even though I think that who knows what will happen, right? Like somebody will do it. We'll see. All right. The other thing too, usage drives pricing type. When I say usage, it's like usage of like, is it from, are they buying storage, right? Is it from a seat perspective? Is it from like, allowing sort of like multiple members on the team using this? That should drive sort of how you think about your pricing, sort of like, you sell by seats, you sell by like the amount of storage they use. That's the whole point I'm trying to make. Sorry, this wasn't very clear when I put it together. It's a little bit jet lagged, so, okay, all right. And the other thing to think about is this a simple or complex product that you're actually building? And lots of implications for this, whether it's from your product roadmap, from a sales perspective, but also from, I think about this also from a pricing perspective, right? Because if this is a complex product, you probably want to have like multiple tiers in general, versus if this is a simple product, maybe you can just get away with just like one simple pricing sort of like structure. Unclear, and this is very, very dependent and contextual according to the company and the industry that you're actually in. And the big part I think is just, this is a law that you should all know, Pareto's law. And the other thing you want to think about when you're looking at customer segments is actually understand what are the 20% driving 80% of the revenues, right? What is 20% of the usage? What you find is 20% of the users will actually drive 80% of the usage of your product. And this is also really, really helpful to help you think about pricing, right? Because what you're trying to do is that for this 20% of customers are driving 80% of revenue, just by optimizing the pricing for these 20% of customers is going to give you way, way bigger results than trying to optimize for the less, I'd argue, less important segments of sort of like your customer base. Right? And so what I'm going to talk about, I'm going to provide 3 sort of like very, very quick frameworks that you use together to at least give you a start. So assuming you kind of follow these principles, or these previous sort of like guiding principles are just some ways for you to help you think about pricing overall. The 3 sort of like, and none of this should be a surprise, but the 3 frameworks are ones that I actually learned from like product management, working with a lot of products that we launched at Yahoo, which I still think are very, very relevant in SaaS business too. This will help you at least have a good sort of starting point for figure out your pricing. And so first framework, number 1, the first thing you want to do is the cost plus, right? And so when I say cost plus, it's like, how much does it actually cost you to actually build this product from an engineering time, materials, whatever it is, with some margin, right? With a reasonable margin. And I think in SaaS, a reasonable margin can be anywhere between 30%. And I would say, if you want to be very, very aggressive, make it 50%, right? Or maybe more. But how do you figure out sort of, and this is just one data point as a framework to use, right? If you're going to charge. So cost plus, right? How much does it cost you to make something with a very, very aggressive and healthy margin? Second thing, that you would be stupid if you do not look at the competitive landscape on what they're charging, and there's several reasons for this, right? Because you want to understand, like, hey, what are my direct competitors, indirect competitors, like what's the model they're charging by, right? Are they charging by storage? Are they charging by seat? Whatever, et cetera, et cetera. And the main reason you want to do this too is just you want to make sure that if you're say if your competition is charging like $1 a month and you're going to charge like 1,000, like you really need to rethink, like, does that actually make sense or not? Maybe it does from a positioning perspective, maybe it does, but it's good to just know sort of like what other folks are actually doing, because a lot of times they've already set a lot of the precedents already, and that's what you're selling into. And last of all is the value base, right? And this actually goes back to that earlier exercise. I think Rich mentioned this, but one of the earlier exercises about the fact that you need to be able to quantify the value that you're actually bringing. And so are you helping these companies make way more money? How much more money are you actually helping them make, right? Or are you helping them save a lot more time, which usually also equates to saving a lot of money? Like what does your product actually do? And so for example, a lot of times I talk to my companies, I go, and they're selling to large enterprise, and so they're charging whatever, like $50 a month, I'm making this number up, charging $50 a month, but then I talk to them and I go, well, wait a minute, like your software is actually like really critical, so by using your software, your QA software, like you actually are removing like how much headcount and saving them how much time to go and work on higher problems. So like in theory, you're actually saving them probably like hundreds of thousands of dollars a month, right? Like I said, these are all random numbers, I'm just making this up. And you're charging $50, like there's something off there, right? Like versus say if you're charging $1,000 or $2,000 a month, that actually might be a better price to charge them. And so the way I use these 3 frameworks is I put them together. I go through the exercise with my companies and use these frameworks to go and see like, hey, like what do we think is a cost plus number? Maybe it's like $10, right? What do we think is actually, what are the competitors charging? Oh, they're charging like $100. And then the value base where it's like, well, but wait a minute, we're saving them like tens of thousands of dollars a month. Like, and you use this to triangulate some type of pricing that you can use to sort of position the marketplace. And then you test it, right? Obviously, this is not the final price that you're using. You test it. But at least you have a starting point that hopefully is coherent and makes sense. And so this is a starting point if you're going to use this. And so this is my last slide, and I can open up for questions after. This is from the legend Mark Andreessen, founder of Netscape, and the VC fund Andreessen Horowitz. There's a great term, right? And this is one of those myths in Silicon Valley that unfortunately has spread, but he refutes this myth of sort of everyone just undercharges, right? He said there's a great term called too hungry to eat, right? and this is a big problem in Silicon Valley too, is that a lot of startups, they don't charge enough for the product to be able to afford the sales and marketing required to actually get anybody to buy it. And so they can't afford to hire the sales rep to go sell the product because you don't make enough money. And the other part that I'm going to stress is why this is actually important and why it's important to price high, why it's in your best interest as well as in your customer's best interest to price high, is because you need that margin to support their business. I can tell you how many of my companies have actually undercharged, and their customers are usually like big Fortune 500 companies, and they're going, you know, like, we're really, really happy with your service. We love what you're doing, but I know, like, this sounds weird coming from us, but like, I think you should charge more because we want to make sure that you're around 1 or 2 or 3 years later on in business because we love what you're doing. And so this is a very common problem. So the reason you charge more is so you can make sure you have the customer service, you can make sure you have the support staff, the customer success, the account management, all the infrastructure to support your customers better. That's what they're looking for. And so don't be a gutless coward and charge properly. Okay.